The following podcast was recorded on Wednesday, March 12th, 2025, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will discuss the current state of the sell-off. Jim, at the time of this recording, the S&P 500 is at 5620. CPI came in better than expected, and the 10-year yield initially spiked lower, but 12 minutes later, yields were at the highs of the day. Is a recession coming?
Well, that's the real question. Everybody's worried that somehow the uncertainty driven around tariffs is going to create a recession. And if we go to the first chart, this is from Polymarket, the betting site, the probability that we're going to have a recession during 2025. It was down around 20%, just 2 weeks ago, 3 weeks ago, spiked over 40. It's at 36% now. A couple of things about this chart and how to read it. I look at the betting markets like looking at the point spread on a football game. It's useful information to know that a team is a 10-point favorite, or it's a pick'em game, or another team is an 8-point underdog. It gives me an expectation of what I should expect, but it doesn't mean that that's what's going to happen. So this is giving us an expectation that there is higher fears of inflation, of a recession coming. Doesn't mean it necessarily has to happen. Also, how to read this chart. A recession comes about once every 7 years. So if you're thinking that there's not going to be a recession, you would put your probability at around 15%, because there's always a 1 in 7 chance that this year could be a recession. So, if you put your odds at 40%, you're saying that there's, a 2 in 5 chance that there's going to be a recession this year. But so the point is, a recession will never be zero unless it's December 31st, and it will only be 100% when you're actually in one. So you got to look at what would be the kind of the baseline chart. So 36% is like doubling the recession odds, roughly speaking, from 15 to 30%. So there's a lot of fear in the market that there is a recession, but it is not something that people think is imminent. If we go to the next chart, this is really the question about what a recession is. And I think that we have to remember what this is. I like to joke, the last person, excuse me, the most unqualified person to tell us when we're going to have a recession is an economist. And the reason I say that is the natural state of the economy is to grow. If we don't do anything to the economy, it will grow. It could grow slow, it could grow fast, but it will grow. 90% of the years since World War II, we've had growth years. The other 10% have been recession, contraction years. What causes a recession? An exogenous event that changes behavior, COVID being the last example. And here's all the recessions on the page since World War II, the start date, and the murder weapon. That comes from the line from Rudy Dornbush in the 1970s. He was an economist at MIT. Economic expansions do not die of old age, they are murdered. So what murders the economy? COVID being the last example. And that's why I say an economist is not going to be, if I dig down deep enough in the payroll report, I will see a coming pandemic. Or if I dig down deep in the payroll report, I will see an Arab oil embargo, or I will see a September 11th. That's why I say an economist can't really tell you when a recession is going to come. And so the question is the next line on this chart going to be, the recession that we're all worried about right now? Is the murder weapon? And to that end, I would actually argue that the answer is no. I don't think it will be the next one on the chart. I think that we're going to see a number of instances where there's going to be concern in the market right now. Or let me restate that in a little bit of a different sense. Is this going to kill the economy? It really depends on what tariffs are being used for. Are they being used for revenue generation, are they being used for long-term goals, or are they being used for leverage? And the day before we're recording is a great example of that. From our perspective, when we're recording yesterday, which would be Tuesday, March 11th, the day started off with Trump sending out a tweet saying that Ontario is has announced a 25% tariff on electricity that comes into the United States. He is going to counter that with a 50% tariff on aluminum and steel effective the next day. Market freaked out. Brad Sester, who is an economist at UCal Berkeley, wrote this long tweet. This is terrible. This is going to lead over the next 10, talking about the 50% tariffs. This is going to lead over the next 10 years to Europe and Canada getting a closer relationship and isolating the United States. Tweet about why that's going to happen. Hit send, sends it out. 10 minutes after he sent it out, Ontario said, okay, we will back off of the 25% tariff on electricity in the United States. An hour later, Trump backed off on half of the aluminum and steel tariffs. So before, Brad, you tell me what it means for the next 10 years, how about telling me whether or not these tariffs are going to make it to dinner time? Because they didn't even make it to dinner time. And therein lies the problem. Trump announces a tweet and everybody says, Trump announces a tariff and everybody says, okay, what if this tariff lasts for 100 years? What does this mean? And they last for like 6 hours because he uses them as leverage in order to get something else. So if he's using tariffs as leverage to get something else, I don't think they're going to cause a recession. If they are going to be permanent, then we could talk the other way. But the way we do this now is we say, here's a tariff for the end of time, it's going to continue. And what does that mean? And they don't even make 10 minutes before we see a change in that tariff. And this is, people are arguing that this is the uncertainty. And in actuality, for all of this tariff talk, there's only been one tariff since Trump was inaugurated that has come into play. And that is an extra 10% on cheap goods coming out of China, and nobody cares about that tariff. Every other tariff we've hyperventilated about said it's going to crash the economy, said it's going to bring the stock market down, it's going to do this terrible thing, that terrible thing, hasn't happened. None of them have happened yet. But some of these tariffs have gotten some goals. He got the retaliatory tariffs removed from Ontario. He also got, an airplane full of migrants that were supposed to go back to Colombia. He threatened tariffs on them. They backed off and allowed the plane to land in Colombia. So he's gotten some things out of those as well. So it really comes down to, what do you think the tariffs are? Are they going to be leverage to get something else, or are they permanent revenue sources? Right now, they seem to be leverage to get something else. And if they are, I don't think that necessarily means recession.
Jim, is the sell-off overdone?
Well, that's a good question. So if we go to the next chart, just to put some numbers on this, here's the next chart shows you the S&P. The S&P through yesterday's close, this would be March 11th, corrected 9%, 9.31%. That is the biggest correction we've seen in the S&P since October of 23. That was when yields hit 5%. And it's slightly larger than last August, when we had an 8.5% correction. It's interesting. I'm old enough to remember last August. I'm old enough to remember everybody frothing at the mouth that the world was coming apart last August. Does anybody remember what the reason was? And I've asked some people, I've had a series of meetings in the last few days, what happened in last August that we were all breathing into a paper bag that the world was ending? And 6 of the 8 meetings I had, I don't remember. And it was the yen carry trade unwind. And that's how fast this stuff gets forgotten as well. But this sell-off is about on par with what we saw in October of 23 and what we saw in August of 24. So this sell-off is nothing historic yet. Now, I'm open to the idea that in a week it might be worse, but for the moment it isn't. But so if we go to the next chart, to put this sell-off into perspective, this top panel, that squiggly, all those squiggly green lines, is from the American Association of Individual Investors. That is a trade association. It's thousands of investors. You pay a couple of $100 and they give you a lot of resources to manage your own money. Association of Individual Investors. They survey those thousands of people and ask them a question every week. Are you bullish or are you bearish? You self-describe yourself. Are you bullish or bearish? You pick the time frame and stuff. And what we got for the last reading in last week, March 6th, was 19.3% were defining themselves as bullish. The top panel, all those little red parts at the bottom half of the top panel are all the instances when it's been lower than 19.3%. There's hardly any of them. And the chart starts in 1987. So there's basically, at this point, 38 years of data. And we're at one of the lowest readings we've seen in 38 years. Now that funky looking chart in the bottom is every time we've been at 19.3% or lower on the Association of Individual Investors, what has been the drawdown in the stock market? How far has it declined? And then the label is the first time we hit it, which is what we did last week. Well, I see 25%, I see 23%, I see 56%, that would be the 2009 sell-off. I see 11%, and then I look at the current one and I see 5%. This is far and away the smallest decline and the least number of days. Today, March 12th, the day we're recording, is 3 weeks after the all-time high. And yet we got people this bearish, this fast. We've never seen the speed of this come quite like this. And so are they too bearish, too fast? Well, at least mechanically, this has been the fastest we've seen people go from all-time high to abject panic. It's been less than 3 weeks, and only at the time that this survey was released, it was a 5% decline. Now it's a 9% decline. So if we go to the next chart, why did they get so bearish so fast? Here's the U.S. Economic Policy Uncertainty Index. So this was put out by Baker, Bloom, and Davis, 2 Stanford professors and a University of Chicago professor, to measure what they call policy uncertainty. They developed this index probably about 15 years ago. And what it does is it measures newspapers, legacy media. It measures newspapers, the 10 largest newspapers, Wall Street Journal, New York Times, Washington Post, LA Times, et cetera, USA Today, the 10 largest papers. They look for keywords. First of all, they look for words of their, economics, policy, and the like, so that they say, okay, here's a story about policy and economics. And then they look for words that denote uncertainty. They got a list of words that, like the word uncertain itself. And they put it together as an index, and that's how they measure uncertainty. So what we're doing is, the way we measure uncertainty is we say, how are the old legacy dead trees newspapers portraying the current policy? And what you see on the right in that chart in the blue is the actual index. It is spiked higher through the end of February. It's monthly number. The bottom panel shows you the 4-month change. Now, why did I pick the 4-month change? Because that goes to the end of October, right before the election. So the amount of uncertainty we have seen portrayed in newspapers is the second highest ever, and the second highest rate of change over 4 months. So let me restate that. The only time we've been more uncertain in the last 40 years or so, because that's how much data we've got on this, was the COVID shutdown. Okay, that was probably the most uncertain and will remain the most uncertain period when we were shutting down the global economy in all of our lifetimes. Hopefully there will never be another instance quite like that again. But what they're trying to tell me is, after a 5% correction, which is now 9, not 10, everybody's hyperventilating about the stock market. We are more uncertain than the worst of the financial crisis, than 9/11, than anything else that we've seen other than the COVID response in the last 40 years. I think that's ridiculous. I don't think that the uncertainty that we're having right now is worse than Lehman, banks failing, and the stock market having. I don't think it's worse than 3,000 people dying in the World Trade Center, having to close the stock market because it's 2 blocks away for a week and worrying about what that meant. Worse to believe that on-off tariffs for a couple of weeks, which never stick, is actually worse than those periods. We're overreacting, is really what I think it is. We are overreacting, and part of the reason is the legacy media is partisan. And I think that we're because this index has gotten a lot of play. So is there more uncertainty? Yes. I'm not saying there isn't. I'm talking about degree, not direction. and the degree is completely, I think, overdone. So we're hyperventilating, like the Brad Sester tweet, about this idea that, well, Trump announced a tariff 10 minutes ago. What happens if it stays 10 years from now? We're going to, Canada is going to, integrate with Europe, and then 10 minutes later it's gone. And so let's wait and see what actually happens, because none of these tariffs have happened, but yet we're freaking out about a 9% correction in the stock market, like we would if it was a 25 or 30% correction in previous cycles.
So given that, Jim, what's next?
So let's go to the next chart. And 2 years ago, yesterday, was another big hyperventilating event 2 years ago yesterday. Anybody remember what that was? It was the bank failure of Silicon Valley. So March 8th, 2023, rumors came that Silicon Valley was going to, it was in trouble. March 11th, today is March 12th, March 11th, 2023, they filed for bankruptcy. And over the period from March 8th to March 17th, as this chart shows, the 10-year yield fell 56 basis points. It's only fallen about 30 this time, but it fell 56 basis points. Silicon Valley Bank was the largest bank failure since the 2008 financial crisis. It was followed up with Republic Bank, Signature Bank, and then somewhat unrelated, but at the same time, another big bank failure was Credit Suisse, which was eventually swallowed up by UBS. So during that period, bond yields fell 56%. That's a big move, bigger than what we've seen on this tariff talk. For the next 2 months, as this chart shows, bond yields, after that big drive, waffled sideways. We talked about exactly the same thing. Is the next line on my chart of murder weapons for the economy going to be bank failures, financial crisis? We were all worried about that. And it was a legitimate worry because we had the biggest bank failure since 2008, as it says on the screen. What happened next? If we go to the next chart shows you the same 56% decline, 56 basis point decline on the left. Then the horizontal line shows you we went sideways for 2 months. And then by May into maybe early June, we realized we weren't going to have a recession. Yields went up 170 basis points. And if we go to the final chart and then I'll put some color on it, what did the stock market do? Well, when Silicon Valley Bank was failing, it corrected 8%. We've corrected 7.75 to be exact. We've corrected 9 right now. Then the stock market recovered, and then it corrected 10% because we went to 5% yields. So here's the thing, I think, is what happens next. If you've got to make a bet on the tariffs. We have to make a bet on the tariffs. Are they going to cause a recession? If the answer is yes, yields will continue to move lower. If the answer is no, I think once we start to realize what's happening, the economy was doing reasonably well 3 weeks ago when we were at an all-time high. Yields around the world, this is probably the least understood or least talked about version of this, yields around the world are going vertical. German yields, Italian yields, UK yields, French yields, Japanese yields are all going straight up. Why? They're stimulating like crazy in Europe, and they're probably going to create a bit of an inflation scare later this year. And Japan has more inflation than the United States right now. So all their yields are going up. Ours are going down on an inflation scare. If we don't have, in a recession scare. If we don't have a recession, they J-shot right back up to 4.80 to 5%. That's your risk. If you believe that we're not going to have a recession and you think they're going to J-shot, and we do, that maybe this is the recession, then they're going to sink real lower. There's a big move coming one way or the other, and it's going to be a very difficult thing for a lot of people to play their hands at. Again, I don't think there's going to be a recession because I don't think anybody is changing their behavior. I don't think there's a business out there that said Trump slapped tariffs on aluminum and steel. Ontario backed off on their electricity tariffs. He rescinded them. That's it. Cancel our 2-year plan to expand our business. No one is doing that just yet. Now, if Trump slapped down those tariffs and said they're going to stay until at least January 20th, 2029, and maybe later, then you might have somebody think that way. So I don't think anybody's changing their behavior right now. They're watching this, they're worried about it, they're trying to understand it. And if not, we're not going to have a recession. And then we're going to default back to 46th month in a row. Today was CPI, as you mentioned, with 46th month in a row above 3% core inflation. Yields around the world are going higher. Europe is fiscally stimulating. Our economy was doing relatively okay before this episode. You add up all that cocktail, and a 420, 430 10-year note is probably going to give way to a 480 to 5% 10-year note as we go forward from here. Now, if things turn around and they get worse and everything else, I'll revise that opinion. But right now, I don't think we're going to have a recession, and I think the risk is you see much higher yields. Stocks probably recover on that no recession turn, but I think the recovery becomes limited to maybe going back to the all-time high because they're going to have to contend with higher interest rates.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again, and have a great day.